My name is Tyler Morley, and it is my pleasure to advise that Swatch Group will outperform the market. I recommend longing this stock because currently it's undervalued by 10 to 20% and has significant competitive advantages, and it's underestimated by the market.
The Swatch Group is a Switzerland-based holding company that has evolved into the world's largest watch producer, managing a portfolio of 20 brands that address all segments of the market. With operations in 3 segments, watches and jewelry proved to be the one on offense, accounting for 97% of net sales last year. Geographically, the majority of the group's sales come out of Asia. In HOLT, the default model scenario appraises Swatch with an upside of 49%. This comes as a result of the company's consistent historical ability to successfully create wealth while allocating additional capital to the business. However, the market implies low expectations despite the firm's track record as a quality company in HOLT, as proved by its consistent wealth creation, with later peaks coming in higher than previous ones. This divergence of value gives way to opportunity. Taking a closer view, we should analyze the underlying drivers, sales growth, margins, and asset turns, to judge the plausibility of these forecasts. And following 3 years of double-digit growth, Swatch's sales slowed to single-digit growth amid unfavorable exchange rate volatility. Currently, with an expanding 16,000 points of sales worldwide, Swatch has leveraged its diversified brand base to pursue profitable growth by penetration of product categories in this emerging geography. Given these prospects of sustained sales growth, tying in HOLT's forecast, it is reasonable to assume a sales growth of 78% with the assumption that the current foreign exchange rate headwinds do not worsen for the Swiss watchmaker. One of the main factors behind HOLT's warranted price for Swatch is its genuine ability to improve profitability, as shown by its decade-and-a-half margin expansion. The main driver of this expansion has been Swatch's evolution through creating a vertically integrated structure, continued innovation, and expansion in its global network and retail penetration. And with this combination of international presence and operational prowess, the group should be able to preserve and reinforce its standard of profitability. Although asset turns have been at a general decline, this comes as a result of asset growth rates exceeding sales growth rate. Altogether, this warrants the use of historic rates for expansion and margins and a modest decline in asset turns for the initial 5 years, followed by fade model. Taken collectively, these competitive advantages enable Swatch's operational drivers to generate positive economic returns and support the view that the firm has a wide economic moat. Put together in HOLT's 3-driver flex model, the assumption yields a 23% upside to the current market price of 530 Swiss francs. Giving wind to this estimated value are Swatch's first place rank in HOLT's valuation score relative to its peers. Strong fundamentals and healthy future prospects, paired with its inexpensive stock price, serve well to explain the company's appraised potential upside. Of course, to realize this potential, Swatch Group will have to mitigate risks such as foreign exchange rate volatility, slowdown of China, and the risk of technology disruption. Nevertheless, we can conclude that Swatch Group shares have the potential to outperform